The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, welcome. We are ready to begin our webinar, How ESOPs Can Increase Employee and Sales Productivity, sponsored by the Rutgers, New Jersey, New York Center for Employee Ownership. I'm Virginia Boccaccio with Rutgers School of Management and Labor Relations. I'm your host and moderator. We have allotted 30 minutes for this presentation. We encourage you to send us any questions throughout the webinar. So we'll be taking questions. You will use the question box. You'll type your questions into the box and press send at any time. The webinar is being recorded and will be made available online and also be sent to you. The link to the recording will be sent to you by email by early next week. It's now my pleasure to introduce our instructor. Stephen White is Managing Partner and Valuation Analyst at Onyx Partners Group. Stephen is active in business valuations in a variety of areas related to fair market value and also has broad industry experience in wealth management by working with hundreds of client companies during his 20-plus years in the investment arena. Stephen provides valuation services related to employee stock ownership plans, establishing buy-sell agreements, acquisitions and sales, and services for family offices. Stephen, I'm going to hand this over to you.
Thank you very much, Jen. Good afternoon, everyone. It actually gives me great pleasure to have the opportunity to speak on this webinar series, educating on various topics in the robust ESOP world. So for the next 30 minutes, I will cover the topic of how ESOPs can increase employee and sales productivity. And I'm a big believer in the notion that in order to understand the how, you need to understand where you're coming from. So I'd like to walk you through a few areas of this particular presentation, first starting off what is an ESOP, but tie you into the three separate areas of benefit that ultimately tie into one another, and that is through which ultimately will help increase the employee and sales productivity is the business owner, company, and the employee. And then I'll wrap up the webinar by discussing how valuations can help enhance the value of an ESOP. And of course, we'll leave time for questions and answers. So let's start where I normally begin, by discussing ESOPs, explaining what ESOPs are. By definition, an ESOP is an employee benefit plan, which qualifies for certain tax favored advantages under the Internal Revenue Code. In order for a company to take advantage of these tax benefits, they must comply with the following, things such as various participation from employees, vesting, distribution, reporting and disclosure requirements set forth by the IRC. And this code was designed to protect the interests of the employee owner. So in addition to the code, ESOPs are also subject to regulations of ERISA, which stands for the Employee Retirement Income Security Act. And this is to ensure that ESOPs meet benefit plan requirements established by the Department of Labor. Now, throughout this webinar, I will refer to some of the language you just heard describing an ESOP, which will assist in understanding why and how ESOPs offer the benefits that they do. Now that we know what is an ESOP and how it is regulated, let's break down the benefits that are
Stephen,
to an owner.
Can I interrupt you? I'm sorry. We just received feedback that it's a little difficult to hear you. I'm not sure if you're on speaker.
No.
No, you're on a handset.
I'm on a headset.
Okay. Maybe we can try again and see how.
Is that better now?
Yes, that's better.
Okay. So as a business owner, as I was stating, you know that as the years go by, you begin to start wondering about the next phase of your life as well as the next phase of the business that you built. Well, the questions that probably populate are, what do you do with the business, or who will you pass it along to? Well, in some instances, businesses are kept in the family and they're passed down to the next generation. However, research has shown that transitions to the next generation typically last for 2 generations, and then it is either sold or it possibly goes out of business. Now, as an ESOP, it grants business owners with several scenarios which include benefits. You have the option of creating your succession plan versus selling to a private equity where you may receive fair market value or less than fair market value. Being an ESOP company allows the owner to stay on over a period of time to assist with this transition. And of course, as an owner, your largest wealth is tied up into your business, which is illiquid. Selling to an ESOP creates liquidity for you. And of course, as a tax-exempt entity, an ESOP offers the business owner significant tax advantages. Now, the tax advantages associated with an ESOP, as I just shared, can be significant for the owner. And these tax advantages basically are different depending on your entity, whether or not you're a C corporation or an S corporation. So let's just focus on a C corporation just for a moment. As a C corporation, in my opinion, the most significant tax advantage that you may receive would come in the form of a rollover. And this is a unique type of rollover that was established by the Internal Revenue Code term 1042, and most commonly referred to in the accounting world as a 1042 rollover. Utilizing the 1042 rollover, the owner has the opportunity to roll the proceeds from the sale of their shares into other investments tax-free. Now keep in mind, there are certain stipulations that apply to the 1042 rollover. The owner must own more than 30% of the outstanding shares post-transaction. So if that is the case, the rollover serves as a deferral of capital gain taxes, which allows the owner to defer paying these taxes until ultimate liquidation of the rollover invested assets. And of course, when you hear this, and it sounds pretty simple in theory, but there are limitations on the rollover investment, and I would strongly encourage you, if this is something that you have an interest in exploring, I'd encourage you to seek advice of both a seasoned tax advisor and a seasoned investment professional. Having both will be critical in the utilization of this particular strategy. Now let's switch gears for a moment. We've talked about the benefits to the owner. Let's take a look at some of the benefits that ESOPs offer to a company. And as I mentioned, the tax advantages for an owner that you can receive from a benefit, from an ESOP are well benefits that they can appreciate from being an owner, but they can also be advantageous to the company as well. For all companies, payments made to an ESOP are tax deductible. When a business sells to an ESOP, this transaction is done in one of two ways. It is either a leverage or it's a non-leverage transaction, and which is outlined in the slide below. So if you look towards the diagram on the left, you'll see a non-leverage ESOP. You have the ESOP trust, the business, as well as the employees. On the right, you have the leverage ESOP. Same diagram, the trust, the company, and the employees, but the difference is now you have another layer, which is the bank or the lender. And in the case of a leverage ESOP, payments are made to the ESOP to satisfy the debt incurred as part of the transaction. So this means that both the principal and the interest payments made to the bank or the owner provide a tax deduction to the company. So while we're on the topic of tax advantages, I was thinking of this when I was putting this presentation together, and I thought about the Tax Cut and Jobs Act that took place last year regarding reducing the corporate tax rate from 35 to 21%, which everyone's familiar with. What was so interesting about this is that the country was really excited about these tax advantages. The reality is that ESOPs have enjoyed these tax benefits for several years, long before the TCJA. In fact, as an example, if you think about it, if you had a company, an S corporation, right, as an example, their taxes are passed through to its shareholders. And under certain circumstances, an S corporation could conceivably pay zero income taxes on its taxable income. And with that thought in mind, I'd like you to allow me to walk you through a tax savings scenario with an S corporation in three different scenarios. And we'll refer to them as Scenario A, which is a non-ESOP. Scenario B, which is 50% ESOP owned. And Scenario C, which is 100% ESOP owned. In the following instruction, you'll see that each one of the scenarios, their income is $8 million. The biggest difference is whether or not they're structured as an ESOP, 50% or 100%. So under Scenario A, the company pays $2,960,000 in taxes at the shareholder level, and thus the company must pay a tax dividend to fund the tax payment. So let's take a look at how this calculation works. You have a taxable income of $8 million. It's zero corporate tax. This is an S corporation. It flows through to the individual tax shareholder, and their tax rate is at 37%. For this illustration, I use the highest tax rate, which is the reason why it's at 37%. So 37% of the $8 million, it gives you a tax dividend of $2,960,000. Under scenario B, it changes slightly. The company needs to take a dividend of $1,480,000 to the 50% of the non-ESOP shareholders for funding their taxes. The company also needs to match the pro rata and make the dividend payment of the additional $1,480,000 to the ESOP. Now, they're still making a total of $2,960,000 in payments, but only 50% goes to taxes, and the other 50% is a mandate payment that goes to the trust, the ESOP trust, even though the ESOP pays taxes. And then finally, we have scenario C. In this company, you're 100% owned by the ESOP. It's a tax-exempt entity, so therefore it pays no tax dividend. So the company has an additional $2,960,000 in cash flow for other purposes. And you could use the tax savings for a variety of different reasons, things such as paying down the debt, paying down existing debt. You can accelerate payment of new debt vehicles, reinvest in capital equipment. You can invest in state-of-the-art technology, build a building instead of paying rent for a third party. I've heard of companies making acquisitions to strategically grow their business, as well as making key hires to organically grow the business. One of my personal favorites actually is creating a sinking fund to pay out retirement benefits to the ESOP shareholders when it is time to redeem their company stock. So I know that I've spent a significant amount of time discussing the benefits that companies can have through tax advantages, but there are also other types of benefits, and from research that show that there's a correlation between revenue and profits. Last year, companies that are part of the ESOP Association, which is an association for companies that are ESOP companies, they participated in the 2018 Economic Performance Survey. And the results from the survey showed that the discussion of employee and sales production are in line with the academic research citing that ESOP companies have stronger performance metrics when pertaining to profits and revenue. So from this diagram in this chart, you'll see for a third year in a row that ESOP companies saw their profits rise. Out of 67% of the respondents to the survey, approximately 19% of them saw their profits rise more than 40%. But the profits were not necessarily the only positive results derived from the survey. Revenues were also up, and they were not up as much as profits, of course, in 2016-17, but nevertheless, the revenues were up. And out of the respondents, 2% of those companies who reported revenue were up 40%, which is a staggering amount for just in one particular year of being an ESOP company. Now, becoming an employee owner comes with its own level of benefits, in my opinion. And a question often comes up as in regards to retirement plans, because when you think of ESOPs, as I mentioned, it is a qualified plan. The question that is posed to me, what is the difference of whether or not I have an ESOP as a retirement plan or if I have a 401k or a defined benefit plan? Well, there are many actually, but for starters, take a look at a 401k. In most cases, it's a program where employees fund their own retirement. And an ESOP is about the company. That in itself is a significant difference. So as long as the participant remains in the ESOP, the value of their benefits and their appreciation value is not taxable to an employee. I think that's a game changer. And I think a lot of it in employee owners also feel that as well. But one of the things that I will share is that if it is possible, and I recommend if your company can maintain this strategy, having both, meaning an ESOP and a 401k or a defined benefit plan, I think this is a very successful strategy in that it not only allows additional diversification from the ESOP, but it allows you and the employee to increase your retirement value. Now, as an employee owner, you can view being an ESOP, being a part of an ESOP benefits in three different ways. You can look at it through wealth creation, stability, and even productivity. And we touch on a few of the areas that help employees with their wealth creations. And studies have shown that being a part of an ESOP employee, have experienced significant things such as higher wages compared to a non-ESOP. And this this illustration, you'll see studies have shown that higher wages for ESOP employees have been up higher 5 to 12%. Your financial assets, that includes your entire investment portfolio, including your ESOP, generally have been rated 20% higher than those that are non-ESOP. You have higher retirement plan, which we'll talk about in a moment, is 2.2 times higher. But the statistic that, for me, that jumped off the page was revitalized middle class. Because if you take a moment and you look at your company and your employees, you'll probably have half or a significant amount of your employees fall into middle class. And take a look at these numbers. 92% have higher median household wealth. These are ESOP employees. 33% have higher income from wages. And 53% have longer job tenure. Again, those are staggering numbers. And these are statistics that have been proven, have shown of companies that have sold to an ESOP, and to see how their employees have grown their wealth, their income, and also experienced longer tenure. When we had the discussion about wages, I was referring to this EPS, which is the survey from the ESOP Association. And one of the things that I noticed that when companies perform well, ESOP employees benefit as well. So if you take a look at this slide, you'll see that 75% of the responding ESOP companies, they increased their wages at or above the national average of 2.7%. And of those respondents, 28% increased their wages by 4% or more. So as you look at their wealth creation, even a part of an ESOP, it is truly a tool to allow you to get to that level. Another area where employees are excited about being a part of an ESOP is the stability. Research has shown that ESOPs lay people off less than non-ESOP companies during down economic cycles. ESOPs offer opportunities for higher wages, as we discussed, for employee owners. And then also, I found this to be interesting, is that ESOPs are also less likely than non-ESOP privately held companies to file for bankruptcy or just close down. So I chose this particular depiction of the employees jumping and shouting because of the mere fact that if you know that you're working for a company where you have stability even during downtimes, or the likelihood, less likelihood of them going bankrupt or closing down as you're growing in this business, it is something to jump and be excited about as well. At this point, we discussed the benefits that an owner receives from selling to an ESOP, and the benefits the company has by being an ESOP, and the benefits that employees can obtain from being an employee owner. So I guess the question still is out there: how do all of these benefits translate to increasing employee and sales productivity? And this brings me to a quote that I heard from a lady. She was the Iowa Economic Development Authority. She once stated, ESOPs are more than just an employee benefit. They are a transition plan for business owners and growth strategy for communities. And that basically states everything that we've just been talking about. Benefits to all three: the owner, the company, and the employee, which translates back out to the community. Benefits tend to generate positive responses and activity. And to support this concept, we had two professors here from Rutgers actually conduct a research to show how ESOP companies outperform non-ESOP companies after they were set up as an ESOP company. And the research that Douglas Cruz and Joseph Velasi performed was to compare these companies of comparables in size, industry, and region. And what their study found, as you can see from this diagram, is that ESOP companies increase sales, employment, and sales per employee by about 2.3 to 2.4% per year against non-ESOP companies. And the research also continued with in identifying the comparison of companies that offered other kinds of benefits. And as you're aware, having a good benefit package can be a great retention tool as well as recruiting tool of exceptional talent. So Cruz and Velasi's study also shows in this chart, ESOP companies, like they have 20% more in defined benefit plans versus a non-ESOP of 4.9. 401ks, you'll find in ESOPs 33% versus 6.2 for non-ESOP companies. Non-401k profit sharing, 35% ESOP, 8% non-ESOP, and other defined contribution, 14.7 to 2.3. Again, these are all benefits that are offered to not only just for the overall company, but they're for the employees to show how they all work together and a positive environment for them to continue to grow. I believe that as far as companies and employees through the ESOP, these benefits are extremely attractive and they're impressive. And we've seen studies and we've heard studies that support the theory that with these benefits, employees and sales productivity do increase, mainly due to the fact that they are part of an ownership. And it creates a different type of culture. And the culture is not the company, it's the culture is the people. And if you're transparent as an owner to the employees once you are part of an ESOP, then they ultimately take more pride in what they're doing and they work more efficiently and they make things come to fruition. And that was typically what happens oftentimes when companies sell to an ESOP. Now, the story doesn't necessarily end there, because we talked about a lot of the benefits that help drive sales and employee productivity. But there's a requirement by the Department of Labor, and an ESOP company is required to have a valuation of the shares every year. And that valuation is used to understand the value of your investment. So let's spend a moment just discussing how valuations can help add value to your ESOP. Now, whether you are in the process of implementing an ESOP or you're contemplating the concept, understanding the value of your closely held company is by far the most important part of selling your business as an ESOP. But I will say the first step is to understand if your business is even ready or if an ESOP is right for you. And I would recommend that you have a feasibility study conducted, which will help you determine if this is the right approach for you. And if it is, and you move forward in valuing a privately held business, understand that there is no one single formula that can be used to determine the value of your business. There are several approaches that can be used to value a privately held business, and none is more superior over the other. And the reason being is that the approach and the methods really depend on the purpose of the engagement, the type of business being valued, the available data, and there are a host of other items. But I'll go over the three most generally accepted valuation approaches and the methods for each approach versus the asset approach. The methods are the book value method and adjusted net asset method, which is typically, this is approach is used for subject companies that may be holding companies such as real estate and or investment companies. The market approach is an approach that is consistent with the analysis of previous sales of company stock, sales of privately held companies similar to your company or the subject company, and the sales of a publicly traded company that are similar to the company itself. And utilizing this approach is to help the evaluator come up with a multiple. And after a series of adjustments between the guideline companies that is used for this particular approach in your business, the multiples are then applied to what is called a benefit stream to arrive at an indication of value. And the last approach is the income approach. And with the income approach, you'll be able to find a number of different methods used. The two most widely used methods are the capitalization of cash flow method and the discount cash flow method. And depending on the cash flow, either it's constant or it's fluctuating, will determine which method is being used. As I said, having evaluation is a critical part of an ESOP. And the report should be viewed as more than just the conclusion of value or a fair market value of the company's share. It should be used as a living, breathing document that is, if it's used correctly, it can be an on-ramp for enhancing the value of your business. And as a evaluator, my job is to, or our job, I should say, is to work with the owner and the management team to uncover items that may be helpful in the growth, as well as identifying areas that can be removed that may cause the area to be stagnant. So ultimately, the valuation report can be designed to be an interactive tool. And those tools will help evaluator identify different key drivers to help you make strategic decisions such as hiring key employees, financial commitment improvements, anticipating tax liabilities, just to name a couple. But the goal is to strengthen the cash flow, which is indirectly strengthens the business value. So as you can see from this diagram, you have growth, profitability, and value. by utilizing the valuation report, utilizing the benefits that the ESOP company can provide, combining those things together, you can ultimately grow the company. You can either grow the company through expansion, you can grow the company internally or externally, which ultimately leads to profitability through the size of becoming the capital requirement, and then increases the value, which ultimately creates a more multiple. The bigger your multiple, the more attractive your business may become to potential future buyers. Again, the idea of how can ESOPs increase the sales and employee productivity is creating the culture where, as you can, employees can also see the benefits that they're receiving is from the work that they're actually providing. And then combining that with the evaluation reports that you have to do every single year, use those to your advantage to find different things that are a part of this a report that can only enhance the value of your business. As a business owner, of course, the one thing that you want is when you sell to an ESOP, you want the business to continue to grow as a part of your succession planning or exit strategy. You want to be able to grow the value that you have. As an employee, you want to continue to create more wealth and maintain that stability where you are. It increases your sales and productivity. It's a win-win across the board for everyone. So I know that we're running up on our 30 minutes, Virginia. So I can pull back here and open it up to any questions that there may be.
Okay. So just a reminder to everybody, if you do have any questions, please go ahead and type them in the question box. And if any questions come to you at a later point, either throughout the day or within the next week, you can always reach out to me and I can funnel the questions over to Stephen, or feel free to reach out to Stephen directly. You can always do that by email. And his email is stephen.white@opgbv.com. So it doesn't look like we have any questions coming in at the moment, Stephen.
Okay.
Do we want to proceed to the next slide?
Well, the next slide is actually
the questions. Okay.
Yeah.
All right. We can go to the next one then. Okay, so we have a save the date. Our next webinar is on February 13th at noon. This is with John Vitucci of PKF O'Connor Davies, and the webinar is Disruptive Wealth Creation by Combining ESOPs with Pension Plans. So you'll be hearing from me shortly with information on how to register for this webinar. And can we go to the next slide? Okay, so Stephen, I want to thank you so much for this great presentation. This does conclude, thank you for your time. This was very informative. This does conclude our webinar for today. Thank you all for joining us for this webinar. As a reminder, the link to the recording will be sent to you via email, and we hope you can join us for future webinars. Here is information about the New Jersey-New York Center for Employee Ownership. So if you have any questions, feel free to reach out to us. And our website is ownership.rutgers.edu. Take a look when you have a second. It has a lot of good information, some resources, and also some great news articles. So thank you again, everybody. Stephen, thank you, and have a great afternoon.
Thank you.